Kia ora, and welcome to the CoreLogic Property Market Update for Pututirangi, March 2025. The Aotearoa property market showed its strongest sign of recovery in February, with values increasing by 0.3% over the month. This follows 5 months of an effective plateau and reinforces anecdotal evidence hinting at the market turning a corner after the extended downturn of 2024. Housing values remain 16.9% below their record highs from early 2022, but still comfortably above pre-COVID levels, with a median value of $807,000. Meanwhile, most main centres experienced value increases, Tauranga being the one to buck the trend, with values dipping 0.2% over February. Ōtautahi Christchurch and Ōtepoti Dunedin experienced the largest lifts in value, both up 0.6% over the month, while Kirikiriroa Hamilton maintained its recent momentum with a 0.5% lift. Tamaki Makaurau Auckland values increased by 0.3%, matching the nationwide figure, while Te Whanganui Atara, Wellington, saw a more modest 0.1% growth. The recent uptick suggests we may well be at the beginning of a new growth cycle, though one that's likely to be far more moderate than what we experienced during the pandemic boom. This improved market sentiment allies with the Reserve Bank's decision to cut the OCR by a further 50 basis points in February, taking it to 3.75%. This follows 3 previous cuts since August and signals the Reserve Bank's commitment to supporting economic recovery, with expectations of 2 to 3 additional cuts throughout 2025. These reductions are flowing through to mortgage rates, improving affordability and encouraging more buyers back into the market. Perhaps the most notable shift in recent buyer activity has been the strengthening presence of multiple property owners using a mortgage for their purchase. This group secured 23.6% of purchases on the latest data, the highest share since November 2021, when the market was at its previous peak. This renewed investor activity reflects both the improved interest rate outlook and the easing of regulations from the government. The notable lift in owner-occupiers moving house in January is a seasonal trend, with these buyers seemingly taking advantage of other buyers perhaps taking a break over the summer holidays. Like multiple property owners, the continued easing of interest rates is expected to unlock some of the pent-up demand from homeowners who had previously put their moving plans on hold during the high interest rate environment. But we'll await more data before claiming that it's the case this time around. Meanwhile, first home buyers, who dominated much of 2024's activity, saw their share dip to 25.0% from a recent peak of 27.6% in October last year. Despite the slight reduction, they remain well above their long-term average, indicating continued resilience from this segment despite facing more competition from other buyer groups. It's also worth noting the number of first home buyer purchases has risen, even as their percentage market share has eased. The shift in buyer composition is particularly interesting when viewed alongside our recently released Women in Property report. The research highlighted the gender imbalance in property investment ownership, with 26.1% of investment properties owned solely by men, compared to 21.9% owned solely by women, with the remaining 51% under mixed gender ownership. This disparity reflects the broader gender wage gap, and potentially also lower access to financial education, and suggests women face additional challenges in building wealth through property investment. While market conditions appear poised for increased activity, it's worth noting that nationwide listings are up 4.1% year on year. This increased supply may act as a moderating influence on price growth, ensuring the market recovery remains balanced rather than excessive. This represents a relatively healthy dynamic, providing buyers with options while falling interest rates improve mortgage affordability and reduce the frequency of forced or desperate vendors, hopefully leading to sensible and sustainable sale prices. Looking ahead, the combination of falling interest rates, improved buyer sentiment, and an optimistic economic recovery flowing through to a broader range of active purchases points to a gradually strengthening market through 2025. However, we should continue to temper expectations. This is unlikely to be a return to the double-digit growth rates seen during the pandemic. Instead, a more sustainable path of modest growth appears the most likely scenario, as the lingering effects of last year's economic and labour market challenges continue to be worked through. Our official sales volume model forecasts a 12% lift from 2024 levels to roughly 92,000 transactions this year, no doubt a welcome improvement after a few subdued years for the many industries linked to the housing market. The debt-to-income restrictions introduced last year may start to have more of an influence as test interest rates fall further and borrowing capacity increases, but for now they're not proving to be a significant constraint. To stay on top of all the latest housing market data and insights, be sure to follow our news updates on the CoreLogic NZ social channels, including LinkedIn, Instagram, X or Facebook. Don't forget to download the Women in Property report for 2025 and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.